Welcome, everybody. This is Axel Merk, President and Chief Investment Officer of Merk Investments. Before I get started and dive into too much into these chart books, and while I talk, I can show you here the first chart. Let me give you a little bit of background and overview. As you are well aware, since late last year, we've been creating chart books on different elements pertaining ultimately to investments. But this one is on the business cycle. We do one on the Federal Reserve. We do one on the S&P 500, and then we have a few others. And we generate different types of things. One of the things we do is we do this particular video that you're listening to right now. This is my in-between the line interpretation. And then we also have a video where Nick Reese, who is generating this chart series in the first place, gives a cut and dry analysis. And he goes through each one of these charts. And I encourage everybody to listen to it. The reason I hesitated for just a second is because I have been working with him to get them to be short and concise and to the point. And his view is, on the other hand, is to have no in between the line reading and to just give you the bare facts with some and tell you the trend and what the chart is telling you. And I've said, hey, you people want to get more. They want to get the in-between the line reading. And so now I got him to be so concise, and that my videos tend to be longer, and I'm just emphasizing a few things. Now, some of you have said that, this isn't enough time to look at these charts. Well, if you read the emails that we send you, if you found it through our email distribution list, to which anybody who isn't on that list, please sign up for that. We'll see is we also create a PDF. And the PDF is a downloadable PDF where you can study these things in depth, and you can zoom in on a chart and do whatever you feel like doing with those PDFs. Don't disseminate them to third parties, but you can, for your own use, do whatever you want to do with them. And then we have yet another set, which is the premium charts. And the difference between the basic chart set and the premium chart set is that the basic chart set is the regular one we show every month. And the premium chart set might be something Nick feels very strongly about, might be something gives extra flavor, or something that we don't show on a regular basis. We want to keep the basic chart set as consistent as possible, so that you don't have this thing where whenever there's news of the day, you grab the one chart that happens to fit the data. And so the point of all this is to give you better tools to have an assessment of where the market is. And the business cycle one is important, as you can see here, because in economic recessions, you tend to have a stock market that tends to not do very well. You can have a bear market when you don't have a recession, such as you had in '87 with the stock market crash. But generally speaking, during economic expansions, the equity markets are doing better. And the other thing you can tell these days, aside from the equity markets, we put a lot of emphasis on interest rates. And during the late cycles of an economic expansion, you have certain things happening, and most notably also that inflation might be picking up. And so we care very much about that, as we do take position on interest rates and can help you take position on interest rates if you're so inclined. But it's this entire picture for those who want to go more into depth that helps. And so here you got my analysis of in between the line readings. Please provide us feedback as to how you want to, quote unquote, consume this format. And please bear with us as we're experimenting a little bit with slightly different formats. Now, for those of you who found this not at merkinvestments.com/research. This is always a good place to go where you get all the links. We are currently working with Patreon as well. That's a service where we can put some premium charts, including this one, behind a paywall. We're currently providing this one without a charge, but we want to have you also be engaged to help us to support this work. We are, by the way this came all about is internally we go through these chart books in our internal research meetings, and we have many more that some of them are rather complex, but we thought, hey, we create these, why don't we share them? But of course, there's some cost involved in creating them. And so at Patreon is currently our channel where you can support us. That said, at some point, we might integrate that to our Merk Investments website. But now let's focus here on the substance. Leading economic indicators have ticked down, and we're still in the expansionary cycle of the economy, an advanced stage. And as you see, we can dip down on these several times before we hit a recession. So there's no quote unquote guarantee you'll hit a recession as one now goes from the top to a tad down. And if I look at the steepness of the yield curve, very much in the news of late, but the yield curve has been flattening for an extended period of time. The steepness is obviously the difference between a longer dated yield and a shorter dated one. Here we show the difference between the 10-year and the 3-year. We think that the yield curve might get inverted later this year. That's quite possible. No guarantee on that. But there's been a lot of talk about the Fed stopping to hike when the yield curve gets inverted. I just like to remind people the Fed's mandate is not to manage the yield curve steepness. The yield curve steepness is a result of their policies. Now, you have some folks at the Fed who are not calling the shots, I might add, who are concerned and might hesitate to hike rates further. Keep in mind also that there are different views of what influences the longer dated yields. Most notably, the long-term yields might be held down in the US due to these extraordinary accommodative policies in the Eurozone and in Japan. And so that is something to keep in mind, and there have been several papers out now at the Fed how this time is different and the yield curve inversion might not signal recession. We're not suggesting that this time is different, but it may be yet another reason why the Fed might not care as much about the inversion of the yield curve. And there is a very good reason why the Fed continues to tighten, and we'll go into that here as we go through these charts. And obviously, please look at our Fed chart book as well to get a more focused Fed look. The Purchasing Manager Index gets a lot of attention these days, partially also because it's been ticking down. Is the economy losing steam? Any reading above 50 is considered expansionary. Now, one of the reasons it's getting attention is because global PMIs have been coming down. And I don't know whether you can see my mouse here, but here the blue line here, for example, is Germany. Germany coming from a very high level here at the end of last year, have been ticking down and just recently ticking a tad back up, but still you have a more mixed picture, a tad of a slowing of a global economy. Not shown here is a lot of global sentiment indicators have been coming down. Now, I would take some of them with a tad of a grain of salt. There's a lot of worrying about, obviously, the US trade policies. And if people are concerned, they might invest less. So don't discount that entirely. But at the same time, to the extent that there are opportunities, people will continue to invest, and we'll see that in a moment here that the U.S. consumers seem to be actually quite happy these days, even if they may not all like the politics. Now, in negative territory, or below 50 anyway, is Russia. That's the Russian line. Last month, Brazil ticked down. Not shown here is Norway. Norway also ticked below 50, and so part of the reason I'm showing you the consistent chart set is that we don't just pull out, hey, Norway is below 50. This is all hell is going to break loose now. And so to see here the bigger economies, and apologies to Norway here, but the other economies here are considered more relevant in a more global context. But above 50 is positive. Unemployment report, obviously well publicized, at below 4%. The cycle low was at 3.8. And the question here, of course, is how much slack is there in the economy? How many people? How hot can you run the economy? How much is there on the sidelines? This is one of the reasons the Fed continues to hike, but there is more. This is a different way of looking at the unemployment rate. San Francisco has a model, that's the gray line. If that were to tick up, then maybe there would be a slowdown in the economy. Capacity utilization. And this year, as you can see, capacity utilization is, and this is just what the CBO, the Congressional Budget Office, is putting out. We can be significantly in the green area, significantly in the red area, above or below zero. That doesn't mean the economy is going to flip the next day. But this is another indication that this economy is running at a good steam. You can put in the full steam, excessive steam, whatever it is, but another reason why the Fed should at the very least consider to quote unquote normalize policy. And by the way, a normalized policy is in many of people's views something like 1% above the inflation rate. And so if inflation around 2%, there would be a federal funds rate of about 3%. And we are clearly not at 3%. But by the way, that's why some people think the Fed is going to stop at 3%. Now, I would agree with that if at that stage inflationary pressures are not more significant. Keep in mind, we have an economic stimulus in place, and unless the trade talks are going to significantly derail this economy, which of course is possible, but not my baseline scenario, I would not be surprised if the Fed's hands at that stage will be tied to continue to tighten because of inflationary pressures. Here, the output gap, another one of these CBO reports that shows that slack in the economy is coming down. Atlanta Fed GDP Now indicator is an indicator we look at, very volatile series. That's the gray series, and it's certainly not perfect, but it does. It's supposed to be a leading indicator of where GDP is going to come in, and it doesn't do such a terrible job if you try to filter out all the noise. In any case, no warning sign flashing here from this one. Then very relevant is how the consumer is doing. And the consumer at this stage is in decent shape. Delinquencies are down, even as rates have been coming up. And that is something to watch. And Nick likes to see these lines cross here so that to see the cycle change. It's very important that, yes, life is expensive and whatnot, but the consumers are holding up. They're paying their bills, and that is quite relevant. Consumer confidence, also very important. Consumer confidence is holding up, and I kind of indicated you may not like the politics, but you might be still doing okay as a consumer. Lending standards. This, in my view, is one of the more important things for the Federal Reserve to watch. And the reason why this is so important is that the whole point of hiking rates, and those who have been listening to me for a while, since I've said this before, well, I say it because it is so important. It is not the yield curve steepness that the Federal Reserve is managing. They want to keep inflation in check. And obviously we can brush off, hey, inflation is not an issue. But the way you do it is you tighten monetary conditions. What that means is not hiking rates. It means that banks are more reluctant to lend or consumers more reluctant to borrow. So you want to see some signs, not stress is an overstatement, but you want to see that things get tighter, right? If you have an economic stimulus in place, the economy is running at full steam, and we are and then we are at maximum capacity, and I'm not suggesting we are necessarily there, but if you are going in that neighborhood, well, you want to take the foot off the gas pedal at the very least, and maybe apply the brakes just a tad. And the places you see it is you'd see the consumer maybe having some credit issues, that they can't access credit as easily, or that they start to kind of default a little bit higher rates, or you see it that the banks becoming more reluctant. But the more typical late cycle stage is that, hey, the banks want to participate in this bonanza, and money is available. You have access to credit. If anything, lending standards might ease. And that's the very reason why the Fed continues to hike. And that is why, in our view anyway, or in my view, it is so common for an economic cycle to end by the Fed continuing to tighten even as the economy slows down. It's not that the Fed doesn't notice the economy slowing down, although they are looking in the rearview mirror and might only see it with a significant delay, but it is because they have to react to monetary pressures, and Fed policy acts with a lag. It is more of an art than a science to get this right. And if you get it right, you're a genius. Maybe you're just lucky. High yield spreads. This is another stress indicator, so to speak. And there is no stress. If it is difficult for the junk sector of the borrowing market to have access to credit, that means monetary conditions are tightening. And that is also why in early 2016, for example, and was mostly related to fracking, when the markets, quote unquote, tanked, when it was the time when in the fracking industry you had some challenges, the Fed got really concerned. They had talked about normalization, had started doing some things, and you saw that access to credit was getting tighter. And that's when the Fed spooks and said, oh, no, we didn't mean it. We have paint drying on the wall when we do our balance sheet reduction, all that fun stuff, right? Whereas now, when you've had little hiccups in the markets, you haven't seen any tension neither in this segment of the market nor many other segments of the markets. And that is why the Fed is going to continue to march higher. This notion that whenever the market tanks, the Fed is going to back off, that applied in 2008 because those things were equivalent. But when the market, when companies have access to credit and the stock market falls, the Fed couldn't care less about that. And I say that it's a bit oversimplified because, of course, they care a little bit about the wealth effect and whatnot. But generally speaking, the concern or the Fed knows the market is reacting if conditions are actually quote unquote tightening, and they are not. And so here again, look at the PDF to study this in more detail. And Nick gave his assessment on all of this. My assessment is that we are in a late stage economic recovery. We are at a stage where inflationary pressures are building. And again, look at our other chart books to look at those details in more detail. And so that the Fed will ultimately be forced to tighten more than is currently priced into the market, with negative implications for risk assets, and investors might want to get prepared for that now. Implications for asset classes and whatnot, I'm not going to go into that right now because I've already used up more than my time. Again, please give us feedback. Tell us how you want this product, how long you want it. Do you prefer the PDF? Do you prefer the video? What style and format video you have it, and whatnot. Give us feedback so we can create a product here that you love and that you are part of creating. Alrighty, thanks then, and we'll quote unquote talk to you with the next chart book due out shortly. Take care.